Hello and welcome to FIS Group's Market Outlook for the second quarter of 2017. We'll check in on what's been happening during the first months of 2017, then offer our take on what's ahead for the next few months, featuring an in-depth look at the U.S. dollar. Risk assets continued their surge in the early weeks of 2017. Emerging markets came out on top of global markets, closely followed by the Eurozone. Japanese equities ended in the negative after a fourth quarter surge. On the sector front, tech led across regions. Elevated inventories and other concerns drove negative performance in the energy sector. Last quarter, we warned of risks to the bullish consensus that the Trump administration would roll back Obamacare, reduce financial and energy regulations, and loosen fiscal streams through tax reform and infrastructure spending. Some of those concerns began to materialize in early March. After hitting a record high, the S&P 500 has fallen 1.8% since March 1st. Small caps underperformed, Treasury yields backed off, and credit spreads widened. Among sectors, financials, which would have been expected to benefit from a pullback of Dodd-Frank regulations, underperformed. Conversely, healthcare facilities rebounded after the failure of Obamacare replacement legislation. We believe the recent retreat in risk assets is a check on the overly ambitious expectations of the new administration's market-friendly policies, as opposed to a threat to the sustainability of the reflation trade. The real story is that global equities are supported by strengthening economic data, causing more positive earnings revisions and giving us our cue for second quarter positioning. For the second quarter, we continue to overweight European and Japanese equities versus their U.S. counterparts. We're neutral on emerging market equities, where negative earnings revisions exceed positive revisions, but the ratio has been on an upward trend. Next, we'll look at our positioning within the U.S. portfolio. In the U.S., we're overweighting value and smaller names to take advantage of favorable entry points created by their first quarter slides. Our sector positioning remains pro-cyclical, with the largest overweight to financials, but with tactical overweights to the more defensive healthcare and telecom sectors. Policy expectations and synchronized global growth will continue to dominate markets this year. In the U.S., valuations are high, and it appears that recent earnings improvements have been largely due to inflation, not fundamentals. Now, we'll turn our focus to the U.S. dollar and its potential wide-reaching impact. The relative strength of the U.S. dollar is poised to influence several market forces for the remainder of 2017. First, currency trends will determine the redistribution of global growth. Second, the balance of the dollar and inflation could affect the pace of Federal Reserve policy changes. Third, a strong U.S. dollar brings with it deflationary pressures that can undermine sectors with global exposure. Finally, a strong dollar usually has a negative correlation to commodity prices and emerging market risk assets. It is likely that monetary policy divergence and more robust growth in the U.S. will continue to support a strong U.S. dollar. What does that mean for global bonds and other world currencies? We believe that the yen will continue to be hampered by the effects of policy divergence between the Bank of Japan and the U.S. Federal Reserve. However, economic or market stress could lead to yen appreciation. Conversely, we believe that the effects of monetary policy divergence on the euro are coming to a close. Divergence between Eurozone and U.S. bond yields and their respective currencies may be driven either by expectations of higher growth in the U.S. or political uncertainty around upcoming elections in France and Germany. Either way, the current levels of divergence seem to be unwarranted. Anticipation that the European Central Bank will begin tapering its accommodative monetary policy by the end of the year is already driving euro appreciation, though action before the impending French and German elections is unlikely. The rally in emerging markets, currencies, and equities was boosted by a retracement in the U.S. dollar and a dialing down of protectionist rhetoric from President Trump, but neither of these trends is likely to stick. Further, As China reins in capital spending projects, emerging market currencies with significant commodity exposure could suffer. Moving forward, we think the dollar's bull run still has legs, particularly against the Japanese yen and commodity-exposed emerging markets currencies. We're reducing our hedge against the euro, and it's in the best position to stabilize against the dollar. On a final note, we want to touch briefly on the issue of inclusion of China A shares in global indices. In late March, MSCI set forth a new and easier-to-implement strategy for this process that is less likely to disrupt the markets. This is part of a larger picture of shifting global emerging markets that we'll be examining more closely in a special report this summer. Thank you for viewing this presentation. For more on this market outlook, our scorecard for the first quarter outlook, and our full global and sector positioning for the second quarter, please visit our website at fisgroup.com or contact us for further information.